Hey traders and A1 Trading VIP community members, welcome back to another educational video. Today we are talking about moving averages, and I'm going to try and break down this concept as simple and as helpful as possible because I actually really like using moving averages. Sometimes you get people who give moving averages a lot of slack. They say they're not great, but I really like moving averages. And in fact, I'm going to tell you guys about my absolute favorite indicator on any chart ever, and that is actually the 200-day simple moving average. I find that to be a really cool tool for identifying long-term trends, and that's exactly what moving averages for me are most useful for, is just identifying the overall trends in the market. So what we're going to do today is we're going to talk about moving averages. What we're going to do is we're also going to talk about some ways that traders can actually use them effectively. So first of all, we need to talk about what actually is a moving average. A moving average is the average closing price over a period of time on a particular chart. It's a very common technical indicator. Nothing fancy here. It's basically just taking X number of bars back and calculating a moving average. What this does is if you have 50 bars back, you're looking at a 50 period moving average. This is basically just going to show you a line of the dynamically moving average for every 50 bars previously. And this can be very useful for just showing you the direction of how the market has moved in a little bit more of a smooth fashion rather than the candlesticks, which can be up, down, and around. The moving average usually is a little bit smoother. So you can see here, this is just an example. You got the 50 period moving average. You can see how it kind of just hugs price, but it lags it a little bit, and that's actually on purpose. So a moving average is, again, just taking the average of the previous 50 bars at any given instance and creating an average. And this usually lags behind price a bit, showing the trend and showing how price is moving. And this is actually usually a pretty interesting and useful indicator because sometimes price can move quickly in one direction only to spike back the other way. And a moving average can help us by just smoothing out the actual price movements that we see in the market. So there's a couple common moving averages that people use in trading. The 50-day moving average is a very common one. And now when I say 50-day, I'm talking about a daily chart, but you can use a 50 period moving average on the 1 hour chart, 4 hour chart, whatever chart you really want to use. This indicator basically measures the closing price of a stock, currency, futures, whatever you're looking at for the past 50 days if you're using the 50-day, 50 hours if you're using a 1 hour chart. And it's very common for traders to use this indicator for a lot of short-term trades. So this can actually be used as a support or resistance level as well. And that's going to be our first way of looking at moving averages. If price pulls back to a moving average in the context of a trend, a lot of times you'll actually see price responding to or even holding and bouncing off of the moving averages that we are looking at. So you can look at things like the 20, the 50, the 100, and the 200 are my personal favorite ones to look at. But again, I mentioned that the 200 is my absolute favorite, the 200-day moving average specifically. So the 200-day moving average is possibly, as I mentioned, the most relevant time period for the indicator, especially on the 200-day chart. And if you actually look at the S&P 500, I would encourage you guys go do some testing and some research on the S&P 500 and look at the 200 period moving average on a daily chart. It's actually really interesting how price responds to it. Usually it decides the sentiment of a market, especially something like the stock market, where you have, if price is above the 200-day moving average, that's a long-term bullish outlook. And if price is below, it's a long-term bearish outlook. And it can help decide if price is really cheap or very expensive. So how can we use it in that way? How can we use a moving average that way? Well, what you'll notice is that when price gets very stretched and far away from a moving average, a lot of times price reverts and heads back the other way. This could be, not in all cases, but in a lot of cases, could actually signal that price is a little bit stretched one way or the other and can cause some pretty decent reversal setups. Here you can actually see a 20 period exponential moving average as an example. Exponential moving average is a little bit different. I would encourage you to go look at the definition or the calculation there. Without getting into the math too far, an EMA provides basically a greater weight on the most recent closing prices. And again, if you want more information on EMAs, go look up the definition. There's a little bit more math involved, and I think for our basic understanding of this, we can just talk about an exponential moving average basically weighs the most recent price action more so than the further back, which makes the price a little bit more stretched or a little bit more adaptable to the current price movements. Common timeframes for an EMA are something like the 10, 20, 50, 100, and the 200 day. or just period, whatever chart you're on. So lots of traders like to draw up crazy charts with tons and tons of indicators. I'm sure you guys have seen some of that. Too many indicators begin to definitely cause problems, and you can get tripped up. In fact, there's a word for this, or an expression for this, which is basically analysis paralysis, when you get too many things on your chart at once. It may not be in line with other indicators. If you have to dig for technicals, then it's probably not obvious to other traders, and the trade might not work in your favor, right? Technicals a lot of times rely on many traders seeing something and jumping in on something at the same time to cause it to move. That's just generally how markets move. So when we're talking about moving averages, again, recap the biggest two things here that I personally like to use them for are looking for pullbacks, looking for trend continuation setups like pullbacks, identifying a trend. And the second biggest way is looking for stretched scenarios where price is very far from a significant moving average, and looking actually for reversals, looking for setups that, hey, this thing looks a little bit stretched. It's a good chance we actually could see price pull back and go back to retest it. So those are a couple ways that I like to use moving averages. Let me know if you guys have any questions. Thanks very much for watching, and let's keep going on to the next video.